There's a 3-digit number that quietly controls more of your financial life than your salary does. It decides what interest rate you get on a mortgage, whether you get approved for a car loan, and in some states, it even affects your car insurance bill. And yet most people have no real idea how it's calculated. A recent industry survey found that 2/3 of Americans either think their income directly affects their credit score, or they're not sure if it does. It doesn't. And that's just one of several misconceptions that are quietly working against people. So in this video, we're going to break down exactly what your credit score is made of, piece by piece, go through 3 myths that are probably costing you points, and clear up one of the most searched credit questions there is: how long do mistakes actually follow you? Section 1. What is a credit score really? Let's start simple. A credit score is a number between 300 and 850. It's built by an algorithm, most commonly FICO, using the information in your credit report. It does not look at your bank balance, your job, or your income. It only looks at how you've handled credit in the past. Credit cards, loans, mortgages, and that kind of thing. A recent industry survey found that 2/3 of Americans either think their income directly affects their credit score, or they're not sure if it does. It doesn't. And that's just one of several misconceptions that are quietly working against people. The algorithm is trying to answer one question for a lender. How risky is this person to lend money to? That score gets sorted into tiers. As of early 2026, the average American credit score sits around 714. Generally, 800 and up is considered exceptional. 740 to 799 is very good. 670 to 739 is good. 580 to 669 is fair. Below 580 is poor. But here's the part: most people skip past. The score isn't one mysterious number. It's built from 5 categories, each with its own weight. Section 2. The 5 factors. Factor 1. Payment history. 35% of your score. This is the single biggest factor. It's simply, have you paid your bills on time? Late payments hurt more the more recent and the more severe they are. A payment that's 90 days late does more damage than one that was 30 days late, and a late payment from last month hurts more than one from 3 years ago. Factor 2. Amounts owed. 30% of your score. This is mostly about something called credit utilization, how much of your available credit you're actually using. If you have a card with a $1,000 limit and you're carrying a $900 balance, that's 90% utilization, and it signals risk to lenders, even if you always pay on time. The lower your utilization, generally the better. Factor 3. Length of credit history. 15% of your score. This looks at how long your accounts have existed, the age of your oldest account, your newest account, and the average age of everything combined. This is exactly why credit history takes time to build. There's no shortcut here, just time. Factor 4. New credit. 10% of your score. This tracks how many new accounts you've opened recently and how many times lenders have checked your credit. Opening several accounts in a short window signals risk, especially if you don't have a long credit history to balance it out. Factor 5. Credit mix. 10% of your score. This looks at the variety of credit types you have. Credit cards, retail accounts, an auto loan, a mortgage. You don't need one of every type. This is the smallest factor by far, so don't go opening accounts just to diversify. So to summarize the weighting, payment history and what you owe make up about 2/3 of your score combined. Everything else fills in the rest. Section 3. The 3 myths. Myth 1. Checking my own credit score will lower it. This is false, and it's one of the most common misconceptions out there. When you check your own score through a banking app or a free credit monitoring tool, that's called a soft inquiry, and it has 0 effect on your score. The only thing that can slightly affect your score is a hard inquiry, which happens when a lender checks your credit because you applied for new credit, like a loan or a credit card. Myth 2. My income affects my credit score. As mentioned earlier, this one trips up a majority of people. Your score has nothing to do with how much money you make. A surgeon and a part-time retail worker with identical credit habits, same on-time payments, same utilization, same account history, would have the same score. Income matters when a lender decides whether to approve you and at what amount, but it plays no role in the score itself. Myth 3. Closing old credit cards will help my score. This one's counterintuitive, but closing an old card can actually hurt you in two ways. First, it removes that account's age from your length of history calculation. Second, and this is the bigger one, it lowers your total available credit, which can spike your utilization percentage, even if your spending hasn't changed at all. If you have a card you don't use but it's old and has no annual fee, leaving it open and inactive is usually better for your score than closing it. Section 4. How long mistakes actually follow you. This is one of the most searched credit questions out there, so let's settle it clearly. Under federal law, most negative marks, late payments, collections, accounts sent to a collection agency can stay on your credit report for up to 7 years from the date you first fell behind. A collection account specifically can stick around for about 7 years and 6 months, since the clock starts a bit later than people assume. Bankruptcy is longer. A Chapter 13. Bankruptcy falls off after 7 years, while a Chapter 7 bankruptcy can remain for up to 10 years. Here's the detail that actually matters, though. The damage from a negative mark isn't constant. The whole time it's on your report. A late payment from 5 years ago hurts far less than one from 5 months ago, even though both are technically still visible. So a mistake doesn't just vanish on day 1 of year 8. Its impact has already been fading the entire time. On the flip side, positive history, accounts paid on time, can stay on your report for 10 years or more, and active accounts in good standing stay listed indefinitely. So the system is, in a sense, weighted to reward consistency more than it punishes any one mistake forever. Section 5. Why this actually matters. It's worth being clear about why any of this isn't just trivia. The gap between credit tiers has a real dollar cost. On a $350,000 30-year mortgage, the difference in interest rate between an excellent score and a fair score can be around 1.5 to 2 percentage points in APR. Over the life of that loan, that gap can add up to well over $100,000 in extra interest paid for the exact same house, the exact same loan amount, just a different number on a credit report. That's the part that doesn't get talked about enough. A credit score isn't just a gatekeeping number. It's a price tag that follows you into nearly every major financial decision you make. So to recap, your score is built from 5 factors. Payment history and what you owe matter most, followed by your credit history length, new credit, and your credit mix. 3 things that won't hurt you, despite what you might have heard. Checking your own score, having a modest income, and keeping old, unused cards open. And mistakes do fade, both in visibility after 7 to 10 years, and in actual impact long before that.